Good afternoon, ladies and gentlemen, and thank you for joining us on this live webinar today. We're looking at the topic of effective credit risk and operational resilience during a crisis. The question that we're trying to answer is how should financial institutions effectively manage credit risk to ensure business continuity during a crisis such as the COVID-19 pandemic, which also has social and economic ramifications. This live webinar is brought to you courtesy of the Zambia Institute of Banking and Financial Services in collaboration with the Bankers Association of Zambia. I am your host, Victoria Chandamumba, Chief Executive Officer of the Zambia Institute of Banking and Financial Services. As you may be aware, the world is currently facing unprecedented challenges from the COVID-19 pandemic, which, as we all know, has evolved from just being a health crisis to a financial, economic, and social crisis. We've noted economies shut down, cities have locked down, businesses have closed, SMSs have closed, massive job losses. This is common everywhere. Much as Zambia, where we're hosting this from, hasn't completely locked down, the impact of the pandemic on the economy is being felt. The Ministry of Finance in Zambia, like many other economies, have already given a negative economic growth projection. And really what we're saying is there hope for the financial sector in Zambia? Is there hope for Africa? Is there hope for the global economy? We are privileged today to have an eminent panel to help us delve into this important discussion and answer the question, how should financial institutions effectively manage credit risk to ensure business continuity during a crisis such as COVID-19 pandemic, both for themselves and their customers? On the panel today, we are privileged to have Ms. Charity Chandalumpa. Now, Charity is a game changer in the financial sector and everywhere she goes. Charity is currently the board chairman of one of the top 5 banks in Zambia, and that's the Zambia National Commercial Bank, Zanaco PLC. She's an accomplished executive with extensive experience in insurance, in banking, tourism, telecommunications industry, to mention but a few. And she has also previously held various executive positions, including Managing Director of the then Zambia National Tourism Board, Managing Director of EcoBank Zambia, and worth noting is there that Charity successfully set up EcoBank Zambia as a greenfield financial institution in 2008 and became its first Managing Director. The other executive role is Managing Director of Airtel Network Zambia PLC. Among many other critical roles that Charity continues to play is the role of Chairman of St. Ignatius College of the Jesuits. She's also an investment panelist of the Malawi Innovation Challenge Fund, an innovation and impact-focused development fund. She's also the matron of the University of Zambia Business and Economics Association. Charity is also the Hall of Fame mentor for the Push Women's Network. Welcome, Charity. Our other speaker and contributor today is Sunny Zulu, joining us all the way from the Middle East, Dubai. Now, Sunny is one of Zambia's finest exports to the Middle East. He's a seasoned banker and is currently the head and managing director of retail banking business at Standard Chartered Bank in United Emirates and based in Dubai. Prior to this role, Sunny was the regional head of Strategic Transformation Alliance, Performance Management for Africa and the Middle East at Standard Chartered Bank. Before he relocated to Dubai, Sunny was the head of retail banking for Standard Chartered Bank Zambia and Southern Africa. He has held a number of senior executive roles within the bank, which include head of retail clients, general manager of distribution for Zambia and Southern Africa, and head of corporate affairs. As an entrepreneur, Sunny is also a joint owner of Air Mafuta Aviation Services. Now, this is a company that he founded in 2009 together with 2 of other colleagues of his. The company supplies aviation fuel to both local and international clients. Sunny, welcome to the panel. Thirdly, we have Mukwandi Chibesakunda, a seasoned banker and a trendsetter in the industry. Mukwandi holds with a wide experience in various financial service industry roles, and she is currently the first female chief executive officer at Zambia National Savings and Credit Bank. This is the biggest government-owned financial institution in Zambia. During her industrious career, Mukwandi has held the position of managing director at Access Bank, in addition to other various executive roles at Stanbic Bank Zambia and the Central Bank of Zambia. She is also the first female president, or whom we can call board chairman, of the Zambia Institute of Banking and Financial Services. She has also been a non-executive board member of the Zambia Revenue Authority, the Vision Fund, and the Global Fund Country Coordinating Mechanism. She is currently a board committee member of the Higher Education Loans and Scholarships Board in Zambia, the Livestock Development Trust Board, the Strategic Committee of the Mulungushi Conference Center, and the CDC Africa list in Zambia. In February, Mukwandi was one of the 10 delegates from across Africa who was conferred with a leadership award from the African Leadership magazine, and now that was a huge achievement for Mukwandi in February 2019. Mukwandi was also recently given an award by the Push Women Leadership Program in acknowledgement of her achievements as a female role model in the Zambian financial sector. Mukwandi, welcome to the panel. Mutsunge Zulu, one of the critical voices behind the economic analysis of Zambia's financial sector, especially during this critical period, providing great insight for decision makers and the general public. Mutsunge is a composite of many attributes. He's a seasoned banker, he's an economist, he's a financial analyst, and is a risk practitioner for over a decade and a half. Mutsunge has worked in the market, operational, and credit risk capacities for Standard Bank Africa regions. He is currently the operations risk head at Stanbic Bank Zambia, and he also serves as a national secretary for the Bankers Association of Zambia. Mutsunge, welcome to the panel. Once again, I am your host, Victoria Chandamumba, Chief Executive Officer of the Zambia Institute of Banking and Financial Services. And with me today is my co-host and moderator for this session, Leonard Bwanza, the Chief Executive Officer at the Bankers Association of Zambia. Leonard, good afternoon, and it's over to you.
Running its affairs in a turbulent and unpredictable environment. Over to you, Madam Charity.
Thank you very much, and good afternoon, everybody. I think this crisis has two meanings, both for the board and the executive management. And I'll respond to that really from a purely strategic point of view. And I think the dangers that we are facing basically as a financial institution, there are about 6 of them mainly. So we have one, the balance sheet and activity protection. We have to make sure that that is a no-go area in terms of upsetting the balance sheet and any activity that in that respect. And secondly, we needed to focus on the care, on the health of all our employees. Make sure that we secure the permanence of management, because management is actually running the business of the bank. So that was also a second danger in terms of the priorities that we saw. We also needed to protect profitability and liquidity monitoring. So there was that risk as well. And I think also we need to understand that the bank is a business. So the focus on the clients, suppliers, and securing the supply chain was equally very critical and is indeed a risk that the bank needed to pay attention to. Again, you find that every threat, every crisis brings its own attendant threats and crises. So we had to expand our risk analysis in terms of this horizon that we're looking at, so that we don't just focus on COVID. What other attendant risks does it come with? And also we had to make sure that we manage potential conflict between the interests of the company and the interests of the shareholders. So there was always that danger of ensuring that if you don't manage this well, anything could go wrong. But there were also opportunities that we needed to look at. That is increasing the preparedness in anticipation of future crises. So let me call it, the COVID-19 was an opportunity for us to prepare for future crises. It presented itself as an opportunity for us. And also taking advantage of these opportunities presented by the crisis and rethinking the business model of the bank, including the business strategy. And in this respect, Zanaco was very strong because in 2020, we decided that we're going to have a very strong digitalized bank. And with COVID, what we have found out that we have brought forward the future benefits of our 2020-2025 strategy into 2020 to kickstart that particular transformation into a digital bank. So these so far were all the risk horizon, the risk environment, but also being very careful to manage our clients, being very careful to manage our liquidity, by mostly upholding the healthcare for our employees and ensuring that there is management to carry forward the business of the bank.
So well said, profitability, protecting balance sheet, delivering shareholder value, wellness of employees. But do you think there will be any chance of reviewing board policies and procedures in the aftermath of COVID-19?
So I think the best thing we can do as a board in the aftermath of COVID-19, whatever that aftermath is, because COVID-19 seems to be here to stay, I think the importance is to review our strategy. How has it been impacted? To review our business model. How has it been impacted? And mind you, there could be both positive and negative impact here, because you find that the need to work from home has exposed that the organization perhaps can be leaner, as an example. Has also shown that some of the systems need to be tightened, especially when you look at cybersecurity and look at IT risk as well. So there's so many things that we need now as we start going back into the new normal, to revisit all our strategies, our risk appetite statements, as well as the focus on the business model. So there will be things that will happen positively in terms of improving the business of the bank, and there are things that we need to look at to improve the business of the bank.
Thank you so much. I'll come back to you later. Madam Kwanji, you have the privilege of having worked in the commercial banking sector, the private sector. Now you are running the largest financial institutions owned by government, with a clear focus on serving the small and medium enterprises. I just want you to help us understand in terms of the challenges that are being faced in the SME sector and how best we could or should help them navigate during this crisis.
Thank you. As you were saying, COVID has had a significant impact from a systemic perspective, globally as well as locally in Zambia. And the SMEs in Zambia have not been spared. We have the health implications of COVID-19, the social implications of COVID-19, and the economic implications. And the economic implications are now being felt much more than the health implications. And the way that we see it as NatSafe is that a lot of the SMEs have seen business disruption. And a lot of this business disruption is coming through very clearly in their cash flows and in their ability to honor obligations, beginning with staff salaries, for example. You'll find somebody who runs a restaurant business suddenly has no business at all, but still has to pay their staff at the month end and still has to pay their tax at the month end. There are particular sectors that have been hardest hit, but there are also some winners. So there are winners and losers. Those who, for example, are in the health industry or change their business to start selling masks. And that's one of the things about the SMEs. They're quite versatile and agile. So they try to adjust according to what is happening in the market. But the reality is that every single business in Zambia has been impacted. And what we need to be able to do is to identify what are the opportunities that are being presented and try and harness those opportunities, particularly for those of us who work with the SMEs. Impact Capital Africa has done an assessment and a review of what the impact is. And what has been found is that 87% of businesses in Zambia have been negatively impacted. So there are some who have been positively impacted, but that's just 13%. And beyond that, 47% of businesses have taken a view that if they don't receive some form of assistance in the next 12 months, they will go under. That will mean that the economy will go through a more disastrous impact than what we have seen so far. And there will be loss of jobs and other implications in the economy. My personal view, having come from the financial services sector in various angles, is that we have an opportunity to make a difference. The central bank has come in and given us a view as regards how we can structure facilities on behalf of our clients, how we can potentially, the most important thing now is to have that conversation. And as we engage with the SME so that we can assist and make sure that whatever it is that we see in our projections is the most confident view of where things are going, so that together we can turn around this situation and turn the crisis into the opportunity it can potentially be.
You have shared very interesting statistics that 87% of businesses, particularly small businesses, are likely to face difficulties in this particular period. And it just speaks to what everyone is saying on the streets. Anywhere you go, everyone is saying SMEs are critically impacted, SMEs have been shunned, they're not being given the support. How can we best respond to their needs? I know there are issues of capacity, there are issues of performance we always sing about. Just what can we do to ensure that we avoid a total economic failure if these 87% businesses may not have the opportunity to run their businesses?
Thank you. I think the immediate opportunity is for the SMEs themselves to take the time to understand their businesses. And a lot of the time, this is a step that is skipped by a lot of the SMEs. And so when you just ask a couple of questions, they can't answer those questions. But when you understand your business, then you can talk about it in a way that is authoritative, and you're able to then deliver solutions. So my recommendation to the SMEs is to understand the business. On the other hand, as financial institutions, we need to be much more empathetic and have a listening ear. Because what tends to happen is that we're very structured in our approach as financial services providers, but this is not a normal situation. We need to be able to step out of our comfort zone and take the time to listen to our clients as well. So even whilst the SMEs need to understand their business, we also need to take the time to understand them and where they're coming from and try and bridge that gap. And I think we have a unique opportunity now with the adjustments in the regulatory environment to allow for us to be able to do that. The SMEs, on the other hand, also need to document and plan for the future or whatever is coming. We need to prepare for the reopening of the economy. What are we going to do is sustainable? So jointly, I believe that we can come together and identify the opportunities to address the gaps and work with the government, with the central bank, with whatever other financial institutions to make sure that together we're stronger for the future.
Well said, we should all jointly push towards having these solutions. I'll come back to you later. Mutisonge, I was looking at the performance of the banking sector in the first quarter. There was a drop in terms of profitability by almost 40%. The Zambian government, through the Ministry of Finance, have actually projected a drop on revenue of about 14.18 billion. It's quite a colossal sum of money to lose. Impairments are on the rise. And being a very keen analyst on the banking sector and the economy in general, can you please just highlight the general performance of our economy, the financial services sector, and please go into whether banks are really helping to provide solutions to the market through continuous credit extensions?
Thank you, sir, and good afternoon, everyone. So, yes, we are in tough times, and just gauging from performance of the banking sector as a mirror of what's happening in the economy will clearly tell you that pre-COVID, we already had risks to growth that speak to the fiscals, balance sheet vulnerabilities. We are coming from an energy poverty era where we had load shedding. All that has priced into the business ecosystem. Business confidence has actually waned. So that then was amplified by COVID. Interestingly, before I delve into the actual statistics, I would like to state that what you see in the first quarter is actually pre-COVID. So meaning the second quarter will actually give us what the COVID effects are really, because then the public health issue would have priced into the business ecosystem. So profitability did ebb lower year on year by 45%, and it was about 24% down from last quarter. And you'd see that there were extremes. Some banks performed extremely well and some were on the lower end. So at aggregate level, in terms of capitalization, the banking sector is well capitalized. But then if we start looking at the skew, we would find that out of 18 banks, there are 3 to 4 banks that are still on the lower end and are struggling and are making losses, while the big 5 are still rather resilient. What was the key driver in the first quarter was credit impairments that jumped about 195%. The impairments were merely driven by credit risk grading. So Zambia was downgraded by all rating agencies, and we are CCC for Standards & Poor's, we are CC for Fitch, and we are CA for Moody's. So that then reduces credit appetite and takes a knock and eroded some of the earnings that were earned in the first quarter. And then if you look at interest costs as well, cost of funding has actually gone up, and cost of funding picks off the yield curve. And the yield curve usually mirrors what fiscal posture is because government borrowing is very high. So you could actually see that what's happening on the fiscals is pricing into the money markets and is pushing interest rates up. In terms of responses, then came COVID. So COVID, we've never had a time in the history of the world where public health has become a big issue, where all resources now from the fiscals are being channeled towards ensuring that public health is critical, where good health is now more important. And let me categorically state that right now it's about survival rather than growth. No one is really much interested in growth. Zambia's forecast, yes, was minus 2.6% according to the World Bank and the IMF at the virtual spring meetings. But then the World Bank last week did revise Zambia's growth forecast to a better quantum, which is minus 0.8%, taking into account the stimulus measures that the central bank has put in, the 10 billion stimulus package, or despite the uptake being very low, only about 30% has been accessed, which is about 3 billion. So you can see that the central bank on the monetary side is doing something about it to cushion some of those COVID-related credit risks. So how this is now trickling down to the average counterparty is, first of all, we need to understand that from a credit grading perspective, there are some banks that have not yet implemented and reflected that in their credit model. So in Q2, expect to see another big knock. And then if we talk about COVID-related impairments, yes, at first sight, we would think we would see bigger impairments, but then we need to take into account that the central bank did allow for relaxation of provisioning requirements. So that would not be as adverse. But then in terms of cash flow perspective, we expect those strains still to price into counterparties who might struggle in servicing their loans. And the other issue is when we talk about credit, we look at it in two aspects. There's the corporate side and there's the retail side. The retail side, we're worried about SMEs. That one is easier to manage because then you have your scheme loans, which can be done, and measures in terms of COVID relief can be done on a blanket basis. But from a corporate perspective, corporates are much more resilient to some of these shocks. And it would be a bit too early to say the impact of COVID on corporates being felt on the balance sheets, because it's actually being felt right now on the retail side than corporates. Corporates take a bit of time for approval processes for everything to take place. But then from a credit appetite perspective, we also look at sectors. Sector appetite, we look at mining, you look at energy, what is happening in that regard because of COVID. So across the sectors, you would see that COVID is now pricing in. And I actually liked what Ms. Mkwandich Vesakunda said, to say some of the effects will then get to be seen even in the second half of the year because COVID effects are still pricing in. So that queue of individuals is still coming. They'll still come and knock at the door. So we'll continue seeing some of these effects then still price into the market. So I would say from a growth perspective, at least Zambia has a little bit of reprieve from some of the stimulus measures from the central bank, and the fact that they also shaved the benchmark policy rate by 225 basis points will also give a little bit of reprieve here and there. So it's not more of an economic decision, it's a social cause because everyone needs to come to the party in terms of commercial banks to help, because at the end of the day, banks are the ones that drive the wheels and the engine of economic growth.
You raise an interesting issue in terms of elevated risks, sovereign risks. Can you just maybe expand more on that? Does it mean because of the elevated risks, they'll be a bit more cautious in terms of giving support to the economy, providing solution to government. Can you just elaborate more on that?
Thank you, sir. So the elevated risks are coming, first of all, we're coming from fiscal posture, which is pretty much elevated, which is driven by external debt. For example, Zambia's debt is 11.2 billion, and there have been concerns around that debt being then reorganized. But at the same time, the government's borrowing needs are very high. And if your government borrowing needs are very high, then you tend to have a sovereign that is overcrowding the money market. So instead of that liquidity, then going into economic sectors and real sectors that will be driving growth, most of it is going back to the government through treasury bills and bonds, and that's what's pushing the yield curve up. So banks then look at the yield curve to reprice credit, and that's what's keeping interest rates pretty much very high. And if your interest rates are high, it means the pressure for your counterparties to service their loans becomes pretty much of a big issue. It actually then leads to the downgrades that we have seen for Zambia. And if your downgrades are high, I mean, Zambia's downgrade was CCC, meaning that banks will then have to adjust what their credit models are, meaning they'll be able to lend less than they should actually be. Their credit appetite then shrinks. They start shying away from certain sectors. But like I did mention to say, we are living in very extraordinary times where we are not following the norm, because ideally, with such a credit appetite, banks should not be lending. But then this is a social cause, and collectively, the banks should still come to the party to lend. And that's the reason why the central bank did come in and relaxed provisioning capital, just to give a sweetener to banks and say, you go and take risks, but then we will give you a little bit of some slack in terms of provisioning and everything to bring back growth to the sector. So you'd find that banks have actually employed various interesting strategies where it's ring-fenced lending, and they are looking at their current books and saying, we can't shy away from these sectors, because if banks shy away from the sectors, we'll have a problem with growth. So banks are still lending to clients, but then they are doing it in a very, very cautious manner. So much as, yes, you would have the liquidity to lend, the issue is, are clients as well coming to provide at least some form of evidence that their businesses have been impacted by COVID? This is where now your cash flows come in and the whole credit conversation, only that this time it's not as stringent as it should be if we were in good times. Thank you.
You also raised a very positive story that capital adequacy ratios are still good. But if we turn around the tables and you do your ICAP assessments and bring in the impact of COVID-19, do you think we'll be still in safe? Are we going to be still in a positive light?
Well, yes, at aggregate level will be in a positive light, because if you look at the big banks, for instance, the top five are very, very well capitalized. The outliers would be maybe 4 or so banks that would be then struggling, but then the central bank still comes in and relaxes some of the capital requirements. So I'll give an example. If you go and look at the non-bank financial institutions, the central bank has actually allowed for them to use assets that ideally would not have been used to calculate regulatory capital to use in this period, because they do acknowledge that, look, if you stress test, if COVID effects really price into this market, they could actually erode capital, and they're trying to maintain financial stability. So there's also assistance in that regard. And then they also do acknowledge that much as we talk about capital adequacy, you can't talk about capital adequacy without looking at liquidity at the same time. And because liquidity could be an issue, hence your 10 billion stimulus package. So, and the central bank did also mention that it will continue being close to commercial banks to ensure that if they need to institute other measures that would then support banks, they will be there. And we are actually seeing that from the central bank. Thank you.
Thank you so much. I'll come back to you. Let me go back to Madam Charity Rumba. Chisunge raises very pertinent questions in terms of elevated risks and also challenges to do our sovereign risk status. I'm a bit concerned in terms of the heightened risk environment. Now, from a board perspective and from a governance and operational perspective, with these heightened risks, are we going to see the banking sector moving away from the conventional way of doing things and redesigning processes? And by this, I mean, for instance, when it comes to credit approval at the board level, it's a tick box process. Have you done this? Have you done this? And that, and that, and that. Now, given the fact that businesses are being impacted, cash flows are reducing, risks are rising, do we see the boards folding their arms, or they'll start looking at unconventional way of trying to help the market?
Okay, firstly, let me protect the banks. We don't go into lending as a tick box activity. We are lending depositors money. We have to be very careful and circumspect about the risks that we are undertaking. So it would be unfair to say it's a tick box exercise. At least in Zanaco, it is not. So it's very important to remember that. I think the risks will always be with us, COVID or no COVID. What we now need to prioritize is the extent of the risk that we're willing to take on in addition to what we're already taking on. And as you know, every bank sets out its risk appetite statement at the beginning of the year. And so what is important now is to review it, especially at the half year, and see how well we can, I think, adjust and tweak that risk appetite statement to suit the new circumstances that we find ourselves in. And ultimately, I think the most important thing is that, and as a bank, really, you want to protect all those customers that give you 80% of your revenues, okay? Because really, it's very important for the bank to continue as a going concern. And therefore, for us, for example, as Zanaco, our focus in terms of managing that risk profile is to go very strongly in our digital transformation process to support the rest of the bank in terms of the dilution of the lending book. But in as much as we're talking the stimulus package, and I think Mutisunge knows this very well, as you do, Leonard, there are a lot of issues that are in that stimulus package that are not providing clarity to the banks, you know, how to apply this particular stimulus package. So there are a whole lot of things that are actually militating against the usage, the immediate usage of that package, because 100% of the risk rests with the bank. And then second, and most importantly, even the non-performing relief that has been provided by the central bank, there's still that 2% that you add now on your new loans. So the burden is still getting heavier. But in terms of our lending, I think it's not so much, well, we don't do tick box lending, but we certainly do at length great analysis to ensure that we are serving not only the customer, but their future as well.
So well spoken, great analysis, prudence, ensuring that you do the right thing. That's what will be said on your side. The customer will say that's rigidity and responsiveness. How do you take that?
So at Zanaco, for instance, we've given ourselves a 48 hours turnaround time, okay? And I think that's not rigidity. That is really a great service level agreement to allow our customer get their funds quicker so that they can get on with the business of whatever they are borrowing for. So rigidity may be important in terms of risk analysis and ensuring that capital adequacy ratios is not breached, in terms of ensuring our ratios, our internal ratios are actually helping the bank maintain its liquidity. If that is what they're calling rigidity, it's a necessity. But in terms of rigidity, as regards turnaround time, that is something that is generally well improved. And the risk analysis now has understood the impact of COVID. That's why we are not changing anything other than to give our clients that leeway, if I can call it, in terms of how they service their facilities, to allow them to continue in the business, even with the dropped demand for their goods and services. It's about continuity more than a tick box exercise.
Thank you so much. Sunny, are you back?
Now, can you hear me loud and clear?
So we can go back to the question I posed. You said Dubai was under total lockdown, and I'm just picturing that the small businesses, the street businesses in Dubai, the tourism sector, the airline industry, they all came to a halt. And obviously then that filtered back into the matrix of how you are handling your clients. So I just wanted you to share with us the perspective in terms of what sort of solutions are banks giving to your clients in such an environment, and what sort of solutions probably the government has also brought out into the market?
Great. Thank you so much, Leonard. Whenever we have a crisis like this one, it becomes very, very important to have coordinated efforts, and the efforts coming from the government, from the different regulators, from the financial sector, but also from individuals themselves. It really calls for an adjustment. So for UAE, for instance, one of the things that happened very, very early in the journey was that the government came in. And, you know, like many other countries, they offered a number of relief measures. But one of the things that they did is they did not leave it up to the banks or the financial institutions to decide whether they want to offer relief measures or not. They actually mandated and directed the financial institutions to give relief to clients for payment of loans. Now, that was done in different, options. One, you can defer both principal and interest, or you can defer the principal only, or you can defer the interest only. Now, where you are deferring the principal and interest, the central bank then realizes to say the banks will be out of money, because once you do that, then that amount of money that you have lent out, you are borrowing from other depositors, and that liability comes to the bank at a cost. So what the central bank then did was to give zero cost funding to the banks to ensure that that benefit is then passed to the consumers. And that really, really helped. But the other option that is available is where you can only defer the interest. Now, if you defer only the interest, it's actually not, I wouldn't even recommend that, because what happens then, your loans will run down very, very quickly, and you still giving out money at a zero cost. And unless you get it at zero cost, you'll be out of pocket. The third option, where you're only deferring the principal, that the interest you continue to collect, that is almost like a win-win for everyone, because for the consumer, you are only paying a smaller portion, only the interest component. For the banks, the loan outstanding still remains, the balance sheet, the book still remains with you, and you're still getting the interest component. And you wait until the time, whether it's 3 months or 6 months, where these loans will come back to operate as normal. But what happens in that case is the regulations they have to support the deferment of those loans. It should not impact your credit rating. So the credit reference bureau should not be affected. The staging from IFRS 9 requirement should not actually be impacted. Even when it comes to ECLs and all, that should not be impacted. And the client should not be impacted in any way. In some cases, you've got the limit in terms of the tenor of those loans. That has to be extended. And the regulation, if there's a regulation that says this loan can only go up to 25 years, but because of the situation, that loan must be allowed to be extended without impacting any of those requirements. And that putting together, then it helps out for everybody. It helps out the banks, it helps out the individuals as well.
So that looks like a blanket stimulus package. Do you see most businesses surviving in that situation?
I'll be very honest, Alan. I think some businesses will survive and some may have a challenge. I think what is important, and I know a lot of people everywhere that are talking about the new normal. The way that I look at it is where we are at the moment, we are still in a transition. What we are adapting to the transition. I think that the new normal has not yet arrived, and we do not know what that new normal exactly will be able to look like. We know the direction, and we probably have an idea of what will be expected. And in terms of when and how, that is something that we need to start planning for. Because, when COVID started, a lot of people thought this was a 3 months, issue and it will go away. And some people now are looking at it to say at the end of December. But COVID does not know December, does not know November, does not know March. COVID has got no idea what our calendar looks like. And this might flow into 2021. And if you look at the actions that different countries are taking, it becomes very, very difficult for all the borders to open up, because there are some countries that have taken preventive measures. and they're bringing their numbers down, and there's a lot of control. And there are some countries that have not. And the moment all the borders begin to open up, then the efforts that those countries that have taken, preventive measures will be diluted by those that have not. That in itself tells us that it will take a long time before we get to what's, soever a normality that we might be thinking of. It will be completely different. So in this process, there are some companies that had, enough reserves, and they can be able to live on those reserves today. They can pay salaries today. For how long can they continue to pay salaries before they reach a point whereby all their reserves have run out? And we have seen companies that before they had people that they said they're not going to let people go, but because this is taking much longer, slowly they're beginning either to cut their pay, or they're beginning to send people on a forced leave. In some cases, they're beginning to announce redundancies. So at some point, it will become very clear that some companies will not survive.
And just to add on, Dubai is an international trade and economic hub, as well as a tourist attraction. The closure of Emirates, I imagine the closure of borders could have an impact in terms of its role in international trade, particularly African markets, because I do know a number of small business Africans, they too tend to travel to Dubai to buy goods for resale in Africa. Can you just give us just a picture in terms of what's happening on the market? Has there been a dent occasioned by the closure of borders, the closure of the airline business, and obviously the slump in tourism visitations?
Yeah, so tourism is probably one of the sectors that has been impacted significantly. As you know, there are thousands and thousands of hotels in Dubai, and most of those hotels, they have currently shut down most of their operations, and in some cases they only have one floor operating. Everything else has been shut down, and that means that a lot of people have been impacted in many ways. But the other part of Dubai is trade, and we have a lot of people from Africa that we are coming to Dubai to buy stuff, for their businesses and so on, and they're not coming this time. What that entails, Leonard, is this is a very, very good time for small businesses and medium enterprises to begin to capitalize and to learn how to be able to run businesses using financial instruments like trade instruments, trade financing that is actually available today. Instead of leaving Ghana and getting on a flight, or leaving Zambia, getting on a flight, coming to Dubai, coming to look at your merchandise, because as we know with cross-border trading, you need the assurance that you're actually buying the actual items that you ordered. But that can be done, in many, many ways. Letters of credit can actually help out. I believe that the more people begin to access these instruments, even the cost is going to come down. A lot of times people avoid because of the fees that you have to pay. But as more people begin to, the costs will come down. And many times, when you look at the cost that you pay for most of these services, and you compare it with getting a flight, coming all the way, spending hotel, and accommodation, and boarding and everything else, it's actually even much higher than the fee that you would pay just by using the instruments that are there, the solutions that are there today. So this calls for that. As we speak, even though the flights, as in the commercial flights, passenger flights are not going out, but cargo is actually going out. The ships are actually going out. And today we still have a lot of people that are making orders. And I have experienced that myself firsthand. And they are making orders, and those orders are coming to many parts of Africa, and business can still be able to continue.
Well said. You're talking about online digital solutions as opposed to physical visitation, and things are changing. I'll get back to you later. Coming back to the local environment, I'll get to Mukwandi. You spoke about what we can do to protect the SMEs. We have the 10 billion medium-term financing facility that the central bank has given to willing borrowers. By this, we mean the financial service providers. What has been your experience in terms of accessing funds under this facility, as well as have we seen funds flowing to the SME sector in a fast manner, or things are still slow?
Thanks, Leonard. The pace of disbursement has not been to the expectations, but like anything that is new or different, there is the initial teething issues that need to be addressed. And I think what we need to be aware of is that at least we're trying. There's something that's happening. And on the basis of that, my expectation is that things should pick up pace. But beyond that, the nature of who we are as Africans and as Zambians is that we still are very agile. And what we're seeing on the ground is that the SMEs are adapting to what is happening on the ground and identifying quick solutions and making sure that as much as possible, business begins to pick up. And based on that, what we're also seeing is a bit of a sea change, bearing in mind that we're early adopters of digital. So you can actually see the change even in terms of the SME business models around digital. And beyond that, what is also happening is that people are now looking at other solutions that will then bridge the gap, so to speak, in terms of the financing. Our responsibility as part of the financial services sector is to identify where we may be able to then build into the digital space, for example. And so one such example on the bottom of the pyramid is mobile banking and mobile solutions. We have seen a significant shift in the market. And as financial services players, what we need to be able to do is to harness this and build on it. Another area that my mind is one that we have not sufficiently delved into is that Africa only trades with each other 1%. And if we were to just take advantage of the new Africa Trade Agreement, bearing in mind that the level of disruption in Africa is lower than most other continents, it may be that this is an opportunity for us to deal locally as well as regionally so that we begin to mitigate the economic impact. Bearing in mind that Zambia has 8 neighboring partners, and if you go into the lakes, we even have a further 3. The SMEs in Zambia may have an opportunity without necessarily traveling to the point that was raised earlier, but to identify other markets. So we're initially 18 million people in Zambia, but we can broaden our reach to 100 million people, so to speak. And so what can we do as a sector? What can we do as a community to start harnessing these opportunities without introducing new risk? And I think that's the challenge that we need to take up, to not just wait for the Bank of Zambia stimulus package to work, but to look at what are the other opportunities broader than just the stimulus package. That will work, and I believe it will actually have the impact that is expected. But what are the other initiatives that we can look at to say, how do we broaden the market? How do we then grow the business and expand beyond what we can see today? Because that is what will define who succeeds and who doesn't. We have to come out of a narrow view of what business is today and identify what can be the business tomorrow.
Well spoken. And you serve a very important segment. The majority of the SMEs are your customers. They are both in urban areas, they are in rural areas, and they've got a very close relationship with NatSave. How are you helping them to navigate through the current challenges? What kind of business advice are you giving them?
What we have found as NatSave is that the biggest issue is actually education. Before you even get to a point where you're talking about the finance itself, the education piece is often missed. And what we're able to do as NatSave on the ground is to engage the local communities, even in terms of just sharing the information about COVID-19, what it is, what it isn't, because there are a lot of myths on the ground. And as a result, people can misunderstand exactly what they need to do. So we have taken that responsibility on the ground in our communities to educate the public. And where we have identified partners who we believe we should be able to back in the interim, even while we wait for whatever implementation is coming in future, we then identify those and we say, how do we back this horse? And by backing that horse, we're also backing that community and the employees and the families. So there's a multiplier effect of us being on the ground and being able to deliver these solutions. But beyond that, what we're also finding is that by just engaging with the community and making sure that people understand, we're bridging the gap as regards the misunderstanding of financial services providers. Because it's almost as though people believe that the financial services provider should just give me money and it's okay, and that's it, I don't have to pay. But one of the things that we have begun to drive is that understanding that we actually take deposits from the public and we lend. So the expectation is that whoever we're lending to needs to pay back for us to be able to build the right quality portfolio. And when people understand that, then they take whatever they receive from us much more responsibly. And we begin to see things begin to change. Another area that we've identified, the agriculture space, we have been very dependent on copper as a community. And what we have identified is with the amount of water that we have and the arable land, agric is the space that we need to build upon. And as Nat said, we have been able to drive a lot of that as an initiative on the ground. So there are various areas in which we have been able to identify how we can make a difference in our local communities. And I do believe I speak on behalf of all the other players in the market, that they're identifying what is their niche, what can they do, and what can tomorrow bring to us.
We need to increase financial literacy, knowledge sharing, so that people understand their obligations, to understand the responsibilities of the banks. I'll get back to you later. Mutisonge, some quarters are actually comparing the current economic crisis we are passing through to what Zambia went through in the late 80s and mid 90s. And others are also relating it to the 2008 financial crisis, but which I'm aware didn't catch a lot more on Zambia. I think Zambia was spared during that 2008 crisis. I just want you to basically highlight to us in terms of the comparison effect. Are we really going back to the 80s in terms of how the economy is going to be impacted because of COVID-19?
Thank you, sir, for that question. So yes, 2008 financial crisis, we're going to look at the Black Swan event and how the subprime crisis had affected globally. But then from 2008 compared to 2020, you see that the world is actually much more integrated, and asset valuation has actually shaved over $40 trillion, and that's massive. And if you look at 2008, those were predictable, those were financial related types of risks, but the difference now in 2020 is that there's been evolution of risk from financial to non-financial. There's never been a time when we thought climate change effects or disease pandemic would then infect financial markets. Would obviously think that a public health issue would be dealt with by doctors and finding a vaccine, but it's as though now central banks are the ones that are throwing money to this crisis. So you see that this crisis in 2020 has actually led to more losses, close to double what the 2008 financial crisis. And if you can imagine, COVID has not yet gone. There's been resurgence of a second wave. Beijing has infections, the US has infections, and you would see that this has led to supply disruptions. Minerals, for example, copper is not able to get to its destinations. Warehouse levels have actually gone up. This is now causing a commodity price crash. There's never been time in the history of the world that oil was trading for negative $40 a barrel. And not only that, if you look at the stock markets, it's pretty much crashed with a few winners like the pharmaceuticals, because everybody's interested in getting drugs and a vaccine. But the other sectors, the hotels, the airlines, everyone needs bailout. And this, it's as though if you look at the COVID pattern of infection, it's clearly destinations where airlines do fly. It also mimics where trade happens. So that same pattern is the same pattern that COVID is actually taking, and then it's actually infected the entire world right now. So because of that, economies have actually shaped growth, and people were more interested in investing in safe haven assets such as the United States dollars and treasuries. But at the same time, emerging market currencies have actually depreciated. Everyone is crying debt to GDP right now in Africa. That's why you have finance ministers that are ganging up through the Africa Union and they're asking for debt relief, debt moratorium. So you'd see that the effects this time are much more catastrophic. It's as though whoever had written a book on risk management and referred to 2008 as the greatest crisis would have to revise that, because now there's disease pandemic, and you would see the interrelatedness. Risk management frameworks are changing everywhere. No one ever thought that a public health issue would then lead to discussions that are pointing to fiscal and economic or monetary policy stimulus. But now even models are changing. Even stress testing, we have to stress test for disease pandemic. We thought Ebola was a big infection, but look at what COVID has done, and it's around the entire world. And then that's how the two then relate. If you relate Zambia to the 80s was more of a commodity price crash where copper had tanked and then it pushed up in the 90s, hit 10,000. But now it's a different ballgame. Very, very similar, only that right now copper is $5,700 a metric ton, but then the integratedness of the world is now transmitting disease. It's as though when they say the West catches the flu, then when the West is coughing, then Africa catches the flu. It's exactly what we are seeing right now. And which brings me to a point where Mr. Besakunda was actually talking about the need for us to start trading with each other. We've so much depended on China. Supply chains is with China. But then the question is, if you can't bring in equipment from China, where else are you going to get it from? So in terms of losses, in terms of capital adequacy and all those metrics put together, put at par, you would find that the 2020 disease pandemic is actually a bigger crisis than the 2008, because everyone, all asset classes are pretty much affected. Thank you.
Thank you so much. Back on the operational issues, do you think financial institutions are facing challenges in terms of submitting regulatory requirements, adhering to regulatory requirements in this COVID crisis?
Not really, sir. I would say the difference this time is that every regulatory intervention in this COVID period has been more like to ease and create that room to accommodate banks. For example, if you look at the central bank interventions and regulatory prescriptions, one around digital, where they've increased the appetite and the limits for digital transactions, where people should now use more electronic money, which is a good thing. If you go to the credit side, you'd find that provisioning, capital adequacy has been relaxed. So when the central banks and when regulatory authorities ease restrictions, everybody is happy. It would be a different case if there was an issue of having to tighten what regulatory issues would be. The other aspect is where I see compliance issues in regulatory framework is when it comes to the 10 billion stimulus package, because one of the reasons, like Ms. Charity Lumba had said, to say, look, it's a stimulus package that everybody knows about, but then the intricacies and the benchmarks, the requirements are sometimes inhibitive, where you are required to have collateral. Even banks have to provide collateral. So you'd find that certain banks don't have that amount of collateral, and the haircuts they're also asking for on that collateral are very punitive. And then you're also looking at a performing book. So what about those banks whose performing books are not good enough, but they have a pipeline of clients who need assistance? Then it means those banks will not be able to access that 10 billion. So those are the small areas, but I think there are more positives than negatives. But if the central bank can look at how they can unlock that piece which is inhibiting banks from taking up the 10 billion, then I think we'll get better assistance and some of those benefits trickling onto the business ecosystem. Thank you, sir.
Thank you so much, Mutsunge. My next question will go to Madam Charity as well as Mukwanji. Earlier on, I think, Madam Charity Lumba, you mentioned that you are looking at protecting your staff, improving their health and well-being. But then there are these softer issues, the fears that maybe the West is yet to come. So I just wanted you to speak to what are some of the key staff personnel decisions that boards and managers are taking in consideration of the current crisis. So I'll start with you, Madam Lumpa, and then Mukwandi, you can chip in. Are there fears that maybe we might see downsizing of employees in the financial services sector because of the impact of COVID-19?
First and most important issue to look at is their safety and well-being. Because right now, our main interest is to make sure that our staff are healthy, maintaining their good health requirements, and ultimately are being productive. And working from home, we've invested quite a bit in ensuring that our staff can remain productive. And we've also understood that during this time, our key focus is to keep the business going. And so there are some, I think, psychological issues to deal with. So we've also gotten a resource to support our staff if they're having challenges in terms of their well-being, in terms of their thought process, in terms of how comfortable they are with this whole matter, to make sure that even their mental health continues to be in good and, shall I say, stable condition. So the focus on the organizational design is not something that is eminent right now. Certainly it will be thought of as we go in the next coming weeks, but ultimately, is the business continuing as a going concern? Is it productive? Are we having the right liquidity? Are we maintaining the right levels of our management resource for decisioning? We cannot at this point in time absolutely have a finger on the solution that our new business model should look like this. I think that would be imprudent. However, we have seen that, yes, there is some level of fat on the organization that can be trimmed. But what is our priority right now? The health and well-being of our staff.
Thank you so much. Probably Mukwandi, you can come in as well.
Absolutely. I agree with the chair regarding the immediate priority. And I think one of the pieces that has been underestimated is the emotional impact of COVID-19 on families, on staff, on communities. Just the simple fact that people have to maintain a social distance. The very nature of who we are as human beings is that we like to be with other people and we want to be able to engage. And isolation and distance then starts playing on the psychology and emotions of the entire community. And I think this is an area that in future we'll have to pay a lot more attention to, particularly as we are dealing with the staff impact and how things show up in future. So to address these issues, what we have had to do, for example, in NatSave, is to engage in a much more proactive way, but also through WhatsApp, for example, whereas previously you would only take certain instructions and they would have to be documented in a particular way. Now we've adapted and allowed for people to share a WhatsApp message and say, this is what we're going through, how do we address it on the ground? And that's also been formalized. And something like that then just eases the pressure on the ground for the member of staff who doesn't feel that they have to go into the office or they have to do a certain thing. We also recognize that financial services have been viewed as essential services. And so at the time when everyone went home and they were working from home, for the financial services sector, there was a key group of staff who still had to come into the office. And there was fear, tangible fear. And we've had to deal with that graduation to where we are now, where people are coming into the office and it's fine. But at that point, when it was skeleton staff, the staff who were required had to also go through a particular process. So I think all those issues then bring in changes for the future. And then those staff who were told that they could go home then had fear for their jobs. Does that mean I'm not relevant? Does that mean that in future I may lose my job? And we've had to keep reassuring people that actually for the time being, what we're dealing with is the crisis before us. What we need to do is to get through this part. And in any case, what has happened is that it's a sea change, but the nature of change is that it presents new opportunities. So it could be that tomorrow we'll adapt and there'll be new kinds of roles, there'll be new kinds of processes that will be required. and we need to wait for that day to deal with that at that point. But for the time being, what we need as a community is to be there for each other and carry each other through this time, because it is a difficult time. Even if the health issues are not as significant in our community, there is a lot of fear, and we need to address that in a very sensitive way.
Thank you so much. We have 96 people listening to this webinar. At this point in time, if there are those with questions, I would like to ask you to type in your questions, and I would like to thank you most sincerely. It's not easy to have 96 people in one room, and especially on a live webinar chat. So thank you so much for the 96 people that have tuned in, and thank you so much to the 4 panelists who are very articulate. They're explaining these issues very well. We can't say anything more than that this is a seriously eminent panelist, and I think they've helped us to deep dive into the challenges that we have. So if there are any people with any question that they need any clarity from the panelists, please type in your question, and maybe Victoria can help me to just check if there are any questions that are coming through.
Yes, indeed, Leonard. Quite a great conversation to go, and a lot of insight has been given. And I think there was a question earlier, or is it a comment from Yona, who was saying that while the risk posed by COVID-19 can be disastrous, it's also a fact that this risk may be an opportunity for some financial institutions to emerge even stronger. Have we identified some of these areas? It's a question as well as a comment. And then there was another one from Charles, said it would have been good for Bank of Zambia to share the credit risk posed in the current environment with the financial institutions to really sweeten their package. So maybe there can be initial comments to that, Leonard. I give it back to you for now.
Thank you, Victoria. So I think the question is about, it's an opportunity for banks to re-emerge from this crisis. And then also there was a suggestion that perhaps the central bank should have considered co-sharing the risk of the 10 billion package. I can start with Sunny. What is your view on that?
Well, I think in terms of the opportunities, I think the first thing that I'll say is it's quite difficult, and usually it doesn't sound well to look at financial benefits that are coming from a crisis, especially at the expense of the consumers. So that should never be seen as an opportunity. However, in terms of the opportunity that comes in, it is by providing those solutions and getting the attention of some of the solutions and awareness that has been going on for some time. I think later it was highlighted to say, for example, migrating to digital platforms, that has been there for a long time, and banks have been working on that for a very, very long time. But what we are seeing during this time is that migration being accelerated, because there are some clients, for instance, that in the past, they were very, very hesitant, but because you're locked up in your home, you have got no choice, no option, then you begin to look for solutions. And when you get those solutions, we are seeing that migration to digital platforms going very, very fast. At the same time, there are financial instruments, which I talked about earlier, which have not been accessed for a long time. But because there's no choice, we are now able to engage with the clients and being able to explain, to say, listen, you can be in your home, and in the comfort of your home, you can be able to do all your banking without going through the traffic, without going through, flights, and all of this is readily available. That is something that is we are seeing that is really being adopted. But for companies as well, we still have in a number of markets a lot of companies that are still paying cash to their employees. There's no need to pay cash to employees. You can actually do it completely cashless, and that we are seeing now the adoption beginning to increase. Even those that are lower tickets, like people who earn very, very low amounts, can actually be paid using platforms that are available, and they can also pay and do their shopping using the digital platforms that are available. This is a migration, and we are seeing it really yielding a lot of benefits.
There is another question while we get moderator back. It's from Charles, and it's targeted to Charity and Mutsunge. He's asking if you could elaborate more on the issues around the Bank of Zambia facility, other than collateral, which is causing low uptake from the banks. That's probably either Charity or Mutsunge can elaborate on that, please.
Okay, I think more from the banking perspective, and really I'm speaking on behalf of Zanaco, because I'm not speaking on behalf of the industry. I think for us, the cost of funds is significantly high in terms of the boost facility, much higher than where we can find our own funds. For instance, the cost of funds for the Bank of Zambia facilities coming to about 17.5%. And whereas we can actually source funds much cheaper, perhaps around 5 and 12%. So that huge disconnect makes it very difficult for us then to take that money, because then it becomes expensive. And then what margin are we going to put there? Because already we're in a constrained economy. And if we add any margin that will allow us to have a return on these funds, it puts our customer again at risk of failing. So this as a primary example is what is making the uptake quite low. Secondly, you will find that the stimulus package gives 100% risk ownership to the banks. There's no risk sharing with the central bank. So again, if there's no risk sharing, where the bank is taking up 100%, the pricing is such that it's no longer a stimulus package. Where is the benefit to the customer, and ultimately, what exposure is the bank taking on now? Mm-hmm. And even they have, shall I say, lightened the provisions. At the same time, they've introduced a new element to the provision of that 2% that you take on as you onboard new risk, again, adding more cost to your portfolio. So it needs to have a further discussion, a further consultation with the central bank to allow this particular stimulus package to do the work it's supposed to be, where it's affordable both to the bank and to the customer at large. From a banking perspective, that's how I would like to respond to that. Mutisunge can take the rest.
Mutisunge, you have a short comment on that before I get to a question to Mukwandi?
Yeah, so I couldn't have said it any better. Maybe the only thing I'd like to add is, I know the question is aside collateral, but I still wanted to delve into collateral in relation to the size of the performing book. So what determines the quantum that you can also access is the collateral and then your performing book. And like I did mention, to say for banks whose performing books have not been so good, then it means that they are already sidelined even before they think of making that application. So these are some of the challenges. And if you can allow me to, there was a question that was asked, which I would like to link to that response as well.
Yes, please.
Where there was a question saying the cost of funding is linked to your yield curve. So the question is, if my yield curve is elevated, for example, the 5-year bond is paying 33%. Mm-hmm. So the question is, why should a bank go and lend to an individual below 33% when we can just get that liquidity and go and lock it up, a 5-year treasury bill, and get 33%? So the spirit in which the central bank came in with that stimulus package was that we will price the stimulus package at 100 basis points above your benchmark interest rate, which is now 10.25%. Mm-hmm. So hoping that banks would then take up that piece, holding constant all these other requirements, to be able to reprice their balance sheets. And as they take up these funds, which are ideally lower priced than the yield curve, hopefully the yield curve would come down. What we've seen is that the yield curve has not come down. There's so much inertia. It's coming down, but at a very, very infinite small pace. Why? Because of government borrowing. Because the same the same liquidity is being crowded out because guess what? The government goes and borrows, and it's through a bidding process, and banks are still bidding high. So which takes me back to the point that Mr. Lumba was referring to say the cost of funding. So there's that mismatch gap, and that's one of the reasons why you'd find that the uptake is also low. There's lack of clarity, there's information asymmetry, and yields are not still coming down. And for as long as yields remain elevated, you know, the average Zambian businesses, they believe that banks just price through the roof, and they would rather shy away and knock on the bank's doors and say, we can't get that money, it's too expensive.
That's quite some insight in there. Moving on quickly, there's a question directed to Mukwandi, and this is asking you, Mukwandi, to just provide some insights onto what Zambia's next steps would be in terms of tapping into the regional market, seeing that most of the SMEs in Zambia are in a way affected by cross-border trade. What is Zambia doing about that from your experience, Mukwandi?
Thank you for the question. My personal view, and this is purely my personal view, is that the SMEs in Zambia have an opportunity to actually begin to add value beyond just the primary point of the exports that we have. If you look at most of the markets in the world, the primary products come from Africa. And we export those raw materials without adding any value. But whatever value you may add will improve the price that you can get from that good. Now, for the SMEs to have this capacity, it will not happen if they operate as individual SMEs. They need to come together in some sort of way to be able to create that critical mass to make a difference. And bearing in mind that Africa is not trading amongst itself, but 28 African countries have signed up to the Africa Free Trade Agreement. Yeah. We can start from there and create that critical mass. So rather than Zambia exporting copper to China and then Tanzania importing copper products from China, we try and figure out how can we then add that value and get more out of our exports between ourselves and, say, Tanzania. There's no shortcuts to this. We have to do the homework and identify exactly who is exporting and importing from where, but that is a start. Beyond that, what we also need to recognize is that we need to survive to get to tomorrow. And a lot of the SMEs are just looking at survival for the time being. So beginning with that survival, how do we then identify what immediate business we can do to just get through survival, and then growth in terms of that free trade agreement so that we begin to address those issues. If you look at the EU, how they have reached a point where each economy is supported in a particular way, it started with them individually as local units making a difference in terms of the SMEs. SMEs are the engine for any business, any country, anywhere in the world. What we need to be able to do is to identify those SMEs, create a process of a hybrid solution so that the SMEs come together and make a critical mass. And then we create that capacity so that we can export amongst ourselves as African countries. And that the government of Zambia has signed up to the Africa Free Trade Agreement, and there are some guidelines in there, and that can be our first step to understand how do we get involved and how do we come together as SMEs. Rather than fighting amongst ourselves and competing, we come together and we say, there's this market that we can better harness and get more value out of. So that would be the first step. Quite interesting. And spot on responses as we are getting to winding up. Sunny, if you are there's a question that probably you may comment on from Dandy, asking about what the specific opportunities. Maybe you can give an example of one or two that banks can take advantage of during this time. And while on that, you may also try to explain, the question is from a business banking point of view, how are banks managing the risk, seeing that banks have closed down, and on the other hand, individuals have lost jobs? So I think it's both from the retail and the corporate banking point of view. How would a bank manage that risk, or how are they managing that risk?
Great. So let me start from the opportunities. I think that communication becomes very, very critical, and I'm very, very happy to see that a lot of banks were very, very good at that right at the very beginning, reaching out to the clients, giving the alternative ways in which they can be able to do their banking. But also what we saw, Victoria, during this time, which is something that I am really hoping that nobody loses, that was the execution, ability to execute within a very, very short time. Mm-hmm. Almost all the players in the markets, they were so quick, they were working overnight. Approvals were coming very, very quickly. I'll be the first one to own up to say, as financial institutions, usually we have not been as good as some of the fintechs when it comes to rolling out new things, and because of a lot of regulatory requirements and approvals that we need to go through. But what this time has proved and shown that it is actually doable, and the banks did that, and I'm hoping that is not lost. And that communication, apart from only getting it, but also we saw that the banks were able to make it much more easier and cheaper for clients to be able to use those platforms. Now, when it comes to some of the things that could change going forward, and some of these might actually not be very popular, but it's very, very important, because managing a crisis is not only during the crisis, it is even before a crisis happens. Indeed. And we have gone through this wave, and this wave might come to an end. There'll be another wave that may be able to come now or later in future. The credit policies then become very, very important. Today, a number of financial institutions across many markets, especially in Africa, I must say, we are still giving out mortgages at 100% LTV. That cannot be able to stand, because in a crisis, those go underwater immediately. And there are some markets that are giving out loans at 110% loan to value ratio. And those become, very, very risky assets. And for me, I would actually propose that it's very important even to have a regulation that clearly states across all markets that you cannot be able to lend above a certain loan to value ratio. You are protecting both the borrower, you're protecting the lender, and you're protecting the industry. Because if the property market goes down and crashes, we know what has happened in the past, even when it comes to debt service ratio. When you look at the DBR, today we have got companies that have taken decisions where they are now giving out half pay. Now, if the DBR is so high, it's going up to 60, 70%, and you cut somebody's salary by half, where are they going to get the money to service their loans? And that creates a challenge, because they need to survive. That DBR has to be controlled, and it may look like it's a very stringent control, but it actually helps, and it prepares us to manage even when a crisis like this one comes in. But most importantly, even from a sovereign perspective, the lending that we do, the borrowing that we do as countries, today we actually likely to see a very big debt trap, because if you look at China, it has lent over $146 billion from 2000 up to about 2017 to African countries. Most countries were struggling to pay that debt before the crisis. You can imagine what has happened with the crisis. Before the crisis, they were struggling. With the crisis, that has just become worse. Now, calling a default has got also its own challenges. And all this battle between the West and the US. And China now is almost like in a trap, because they say, if we say African countries have defaulted and the consequences come in, then they'll receive all the criticism coming in from the West to say, yes, you lent these countries, you are irresponsible. And now there's this challenge that has to be managed, and a lot of restructuring coming through. And going forward, as African countries, we need to think about how we manage our debt, how not only to restructure, but before we even contract, and ensure that we do not find ourselves in the current situation that most countries are going through.
What I was saying is that before I get to Mukwandi to comment on one of the key items, there is a statement coming in, say banks should be more clear, or rather deliberate on what they're doing to help struggling businesses, saying that the economic hardships have hit hard on businesses, and the comment is on interest, cost of borrowing, the collateral issues. And with that in mind, Mukwandi, there is a question on how the financial institutions or banks in particular are assisting the agricultural sector, and seeing that the Zambia in particular, the government is advocating towards a diversification, diversifying towards the agriculture sector. How are banks helping the agricultural sector in terms of boosting the business as one of the survival mechanisms for our market? Mukwande, you may just give a comment to that quickly, please.
Thank you. One of the things that I have discovered, having been a banker in this market for a very long time, in the recent past, literally all the commercial banks and financial institutions are ready to work with the agriculture sector in some way to grow it. And there are different strategies. I mean, you can't demand that every single institution runs with a particular point of view. But what I have found is that the first thing is the access to land. A lot of financial institutions are facilitating the access to land and title and various others. Whereas previously, you had to have landed property. Now land itself has been given value, and that is huge. Second, again, moving away from landed property, there is the Movable Property Act, which means that if you have movable property, you can actually bring it in as potential security. The uptake hasn't been that high, but has embraced this quite aggressively. And what I believe is that with time, and as things are tightened up, we'll see a lot more of this being utilized as a potential collateral option. But for us to really be able to grow the agriculture sector in Zambia, it has to start with us. How do we view agriculture as Zambians? Because remember, the financial services sector is part of the community. And if we as Zambians don't view agriculture as something that we need to run with and build on, and is viewed positively, that mindset, if that mindset doesn't change, nothing will change. So before we talk about the financial sector, I should ask you, how do you view agriculture? Because that's the starting point. And if all of us can begin to start viewing agriculture as a potential source of wealth for the future, it will begin to change even in the financial services sector, even in government policy and various others. What tends to happen is that we point fingers at the financial sector without understanding where we play a role in driving this mindset. So my challenge to everyone is that let's identify how we can be part of the solution in terms of agriculture, and being people who can play a role in that change. How do we then together begin to see that difference? So there has been a lot of change in terms of policy. There could be more. As NatSave, we play a big role in the agriculture sector, but I'm speaking now on behalf of the entire financial sector. Yes. And I think that it shouldn't just be for the financial sector. It should be for all of us as Zambians.
That's very Cardinal Mukwande, and thank you so much. And we are closing up, and in under 30 seconds from final remarks from each of our able panelists, beginning with Charity, your final comments on the topic. And for the benefit of the participants, these webinars will be running, I think our plan is to run them almost once every week. We have a panel coming up shortly, I think in the next week, on cyber resilience, and you will see that this will be tied to digital transformations. I've seen some of the questions bordering on that, so we still have a lot more to learn. We still have a lot more to get even from our panel today. So in under 30 seconds, Charity, your final comments, please.
Okay, so I think as boards, we should step up our game and guide our organizations for resolve and resilience in terms of support through the crisis, so that we ensure that management always adopts a scalable crisis operating model, and also to augment our leadership capacity in terms of the executive management, and to strengthen decision-making, particularly by sharing crisis management experience. And we also need to now start balancing the short-term and the long-term priorities. But most importantly, what is the return looking like? How are we as a board leading our organization into the reconstruction phase? Because it's pointless looking at the here and now. We're going to come out of it, and what are we coming out into? So we need to engage on major decisions, catalyze maybe a strategy review, and review the operating model whilst managing our shareholder and broader stakeholder communications. But lastly, and the most importantly, I think we need some more what I would call reimagination. What's our new today? What is going to look like? Because we are bringing the future to today. We can't wait for the future to happen. So what will it look like? And help reassess the organization's purpose and value proposition for the next crisis.
Indeed. Sunny, your comments from Dubai.
Yeah, sure. So my last and closing remarks, I would say that it's very, very important for all of us to remember. Zambia is not an island. Malawi, Nigeria, Kenya, Ghana is not an island. Therefore, whatever decisions we take today will determine how the global economy and the global market will be able to interact with us post-COVID. As the markets begin to open up, I believe it will be done in phases, even when it comes into borders opening up, flights opening up. The ones that are taking measures that are assuring the global economy that it's safer to do business with you, not only from a health perspective, but also from an economic perspective, then becomes better for us. That becomes very, very, very important. And as businesses, it's very important for us to think about how we become more agile, how we become more nimble, because that will be required to manage in this time, even in the time to come in future. So that is very, very important. And as individuals, we need to think about diversification, because different asset classes have performed very differently. You cannot put all your investments in property. You cannot put all your investments in cash. You cannot put all your investments in funds or mutual funds. That diversification becomes very important, because all of these are impacted differently. Get a financial advisor and they'll be able to help.
Thank you. As we get to Mukwandi, just a word to our participants. You may type in your takeaways just in a word or two from this session as we close up. Mukwandi, your final comments.
Thank you, Victoria. It has been said that change is the only constant. And part of what has been very clear in this COVID-19 is that there's been a lot of disruption. And the best outcomes come from those who have a mindset to accept the change and be ready for tomorrow. So as financial services players, as customers in and of ourselves, what we need to be able to do coming out of this session is to identify how should we accept this change, harness it, and deliver to the opportunities that are being presented to us so that tomorrow is a better day. I'm looking forward to that.
Mutsonge, the analyst, give us your final words.
Thank you. So maybe my final words are that 2020 is going to be a tough year, and we need to look at adversity and see opportunity in it. And that's the only way this economy is going to get back to growth. And we also need to take very keen interest in trends, because I think my personal observation is that information is power, and if people are reliably informed about trends that are happening, then it becomes easier to make certain decisions. And then we need to also appreciate that risks are evolving. Now we're talking non-financial risks. Previously, we were talking about financial risks, but there is a link between the two. And only when we start to connect the dotted lines will we then understand that strategic implementation must be a reflection of everything that is happening. So I think from my end, that would be my last words. It's going to be a tough year, but with the right strategies in place, Zambia is pretty much well poised for resilience for this COVID pandemic effects. Thanks.
Indeed. Thank you, Mutsunge, for still giving us hope in that caution. And we've noted in summary that financial literacy during this period is very key. So financial institutions, I'm sure, are endeavoring to ensure that information is passed out to the customers and the general public. There's need for right liquidity that will support the SME sector. There is need also to prioritize the well-being of workers and the customers. The issue of empathy comes in this regard. financial services is seen as an essential service. So financial service providers are also at the front line in the fight against COVID-19, and we should think of them in that regard. There is also need to reimagine the future, and we're saying the future is today. We should not wait for change. Change is the only constant. So the future is now. Let's reimagine the future, because a lot has evolved. And just speaking on a few comments from Sunga, there is need for managing crisis, and it should be now and not after. And all these comments that you have, benefited from this particular session. We thank you so much. From Nancy, very insightful. My takeaway, there is still work to be done. That is very important, and the financial sector is taking note of that. So from me, Victoria Chandamumba, your host for this session, and Leonard Mwanza, who's been our moderator. I've had on the panel Charity Chandalumpa, who is the board chairman actually of Zanaco, the biggest, one of the biggest banks in Zambia. Charity, thank you so much for your valuable contributions. There's been Mukwandi Chibesakunda, the managing director of NatSave, again, the biggest financial institutions owned by the government of Zambia. There is Mutsunge, who's a financial analyst. Thank you, Mutsunge, for your valuable input, and the head operation risk from Stanbic Bank Zambia. And Sani Zulu joining us all the way from the United Arab Emirates, Dubai. Thank you so much. It's been valuable indeed. Please watch this space for more upcoming insightful discussions such as this. I am signing out, and thank you for your time. Bye-bye.